Welcome to Deep Economic Thoughts with economist and best-selling author Ivan Elon. Once in a while, Ivan shares an unscripted, though potent, idea related to economics or the capital markets. This may be of interest to financial advisors and retail investors alike. Enjoy.
Thank you very much for joining me again. This is Ivan Elon, the founder and chief investment officer at Align Wealth Advisors Investment Management, also known as AWAME. And this month, I wanted to focus on a topic certainly which would be top of mind for a lot of investors, both institutional investors and retail investors, and that is the S&P 500 cyclically adjusted earnings yield. I know you spend many hours pondering and really deliberating over this subject. Maybe not, but if you're not familiar with the cyclically adjusted earnings yield, I encourage you to Google it. A great economist by the name of Robert Shiller developed this perspective many decades ago. And it's a helpful way to what I would call harmonize the value of stocks versus the value for bonds. And it standardizes it or harmonizes it in a way so that we can compare these very different asset classes, stocks and bonds, in an apples to apples type comparison. Most of the time, when we're considering stocks or if we're considering bonds, you're really left to have to imagine which may be better than the other. But the earnings yield conversion to a stock is quite simple. All you have to do is take the price earnings ratio, which right now in the S&P 500 is close to about 27 or so, and you just invert it. So you take 1 divided by 27. Whatever the PE ratio is, just take the reciprocal of it. In doing so, that gives you a percentage, and that percentage is the earnings yield. And right now, the S&P 500 Shiller cyclically adjusted earnings yield is around 2.85%, 2.86%. And what that does is it represents the yield from earnings. Now remember, stocks are the stock prices are very much correlated to the expectation of their earnings. And as a matter of fact, and you can, if you're a CFA candidate or CFA Institute member, you will find that this is a subject that is talked about extensively and certainly looked at from many, many different ways. But essentially, the price of a stock is the present value of its future earnings. And so using the earnings yield, this very simple reciprocal calculation of the price-earnings ratio is a very clean and quick way to evaluate whether stocks are priced very fairly compared especially to bonds or fixed income securities, particularly risk-free rates like the U.S. Treasury. And so as an example of this, with the earnings yield currently being in the high twos, let's just call it 2.85%, even with the recent volatility that we've seen so far in August, it's still only around 2.85%, whereas the 5-year U.S. Treasury yield is close to 4 at 3.97 as of the end of July. So this is, and I think it's come down a little bit since the end of July, but it's still demonstrably higher than that 285 level, 282 officially at the end of July for the earnings yield, 397 for the 5-year Treasury rate. And the 5 years is kind of a fair rate to look at because when you think of buying a stock, 10 years is a long time to think about holding it, but 5 years is much more reasonable of a time frame to consider a rate of return or a yield from a particular security. 2 years is probably too short, and so we use the 5 year as a better time frame of reference. And so when you compare even the 5 year to the cyclically adjusted earnings yield, you find that it is about 151 basis points below the 5 year Treasury rate. So the Shiller earnings yield is 150 basis points below, which means you're getting a yield that is 150 basis points lower per year over that 5 year time frame, expected time frame for the earnings. Now that would mean, just at its face value, that stocks may not be such a great buy. As a matter of fact, fixed income looks like a much more attractive buy, providing a yield closer to 4%, where the stock's earnings yield on the S&P is closer to 3%. So it's sort of an obvious advantage for fixed income. And of course, this changes throughout history. So it doesn't stay stagnant. This is always whipping around. And one of the ways that you can get the earnings yield up on stocks is to see prices go down. And when you do that reciprocal of the price-earnings ratio, instead of having price on top and earnings on bottom, you'll have earnings on top and price on bottom. So when the denominator of any fraction goes down, you get a bigger number. And so that's one way to get an earnings yield that is certainly more attractive and even possibly beating fixed income. You would want to see stock prices go down. And the other way to drive the earnings yield up is to have really great earnings and significantly higher earnings. And so that latter condition of having significantly higher earnings is not particularly something that we're hearing a lot of from Wall Street forecasts and analysts. Earnings look relatively stable to slightly growing, but you've had a huge price increase with this anticipation of really exponentially growing earnings, especially for the Magnificent Seven. And so that does look like it's cooling a bit in terms of that trajectory. So perhaps prices have to retrace. Prices perhaps have to come down even more in order to become more attractive once again from certainly the fixed income perspective. Because if you can get a yield of 4%, essentially risk-free from the U.S. Treasury Department in a U.S. Treasury bond, why would you be so attracted to get a 2.85% yield from stocks in earnings yield when a stock price is really only ever the present value of all its future expected earnings? And so it just feels less meaty, feels less satisfying to own stocks in an environment where interest rates are certainly much higher, and 5 year treasuries, as this example goes, is much higher. But of course, things are changing. Short-term rates are coming down, long-term rates are kind of remaining stable, but there's a lot of movement and volatility in yields right now along the entire yield curve. So that also will play a factor in this comparative game, which is certainly something that I encourage you to look at very closely and monitor very closely. And of course, as that happens, that could make stocks more attractive, just because the yield environment is also changing and coming down, particularly on the short end. So those are things to consider this month. And of course, if you have any questions or want to pose another topic for one of these podcasts, please don't hesitate to submit them at our website, which is there's a link to it, as well as a link to the research highlight in the body of this podcast. Thank you very much.
For more deep thoughts, please subscribe to this podcast. Also, please feel free to visit www.ivanilorn.com to submit questions or topics through the contact page. Until next time, keep thinking deeply.